Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the JPMorgan Nasdaq Equity Premium Income ETF that goes by the Bloomberg ticker JEPQ. This video is done as a follow-up request from a viewer's comment in my previous video covering the News S&P 500 High Income ETF. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. JPMorgan Chase is a leading global financial services firm with over 225 years of history and currently managing over $3.9 trillion of assets across a wide range of businesses. Chase is primarily a US-focused consumer and commercial banking brand, while JP Morgan is more for global banking and financial services. JP Morgan Asset Management, as the name implies, is the asset management business for JP Morgan globally. JP Morgan Asset Management manages over $3 trillion of AUM across equities, fixed income, multi-asset, alternatives, and liquidity solutions through more than 1,300 investment professionals. These are slightly outdated statistics on their website, so I imagine these numbers would be all bigger by now. The JP Morgan Nasdaq Equity Premium Income ETF lists 5 co-managers in the fund webpage. Hamilton, Eric, and Andrew have been involved since the inception of the ETF in 2022, while Matt and Judy were only added in November 2024. Besides Hamilton, the rest have been working in JP Morgan for their full career life so far. Hamilton is the most experienced in the group, with 38 years of industry experience. He is also the head of US Equity Derivatives team and has been focusing on US equity markets since 1987. Eric brings to the team quantitative research and data science skill sets, while Andrew provides large cap market and equity long-short strategy perspectives. Matt and Judy were previously US equity value analysts and moved over to this new role focusing on equity options-based solutions. I think this is a nice mix of managers of slightly different skill sets. The JP Morgan Nasdaq Equity Premium Income ETF actually comes in 2 listing versions. The original US listed version was incepted in 2022 and has a much bigger AUM of over $30 billion. Given the success of the strategy, JP Morgan decided to launch a Europe UCITS version in late 2024 that currently has a much smaller AUM of over $2 billion. Both versions are using JEPQ as the Bloomberg ticker, so do make sure you double check which version you are investing into before confirming your trades. Given the US listed version has a longer track record, I will be mainly referring to it in this video, though I will mention about the Europe listed version where relevant. This ETF is also one of the 3 ETFs available under the Equity Premium Income range for the Europe listing that are currently being featured on the JPMorgan AM website. Given this product is focusing only on Nasdaq 100 index, it is definitely a less diversified strategy compared to the other 2 products that are US equity and global equity exposures respectively. This product is an active ETF that is essentially an actively managed fund strategy that is implemented in an ETF structure. Many fund providers, including JP Morgan AM, as seen in this extract from the ETF brochure, advertises this as combining the merits of 2 worlds. I think this is more of a marketing thing, as the reality is that firstly, ETFs have gotten significant investor flows in the past decade relative to mutual funds. Therefore, fund providers do want to jump on the bandwagon to participate in where the flows are. And secondly, there is less dependency on distributors these days, as investors are more savvy and can easily obtain financial knowledge and trade online. Therefore, fund providers no longer need to rely on distributors to market mutual funds that come with high trailer fee structures. In short, active ETFs allow fund providers to remove the middleman and continue to provide actively managed solutions directly to investors. Let's get back to the ETF. The investment objective of the ETF is worded slightly differently between the US and Europe listed versions. Nevertheless, it is clear that providing income is a key objective. Otherwise, the product name wouldn't make sense. There is also an objective for capital appreciation or growth, though we know that nothing is for free, so we will see later how much capital growth are we potentially sacrificing for the income objective. The US fact sheet provides a quick summary of the investment approach, where it states the ETF uses a quantitative or systematic driven approach to invest similar to the Nasdaq 100 index that can be categorized as US large cap growth stocks, while at the same time also sells options. The ETF is designed to provide a monthly distribution payout that is generated from the option premiums and stock dividends. Investors should expect to receive returns correlated to the Nasdaq 100 index, but with less volatility. What is not stated is that the expected returns should be lower as well, since nothing is for free. Let's go through the prospectus for more details. The first part is mostly the same as the summary in the fact sheet. What is different is that the prospectus clearly states that the option selling in the strategy is specifically equity-linked notes or ELNs on the benchmark index. Therefore, the strategy does not involve selling covered call options on single stocks. The expectation of the product, as mentioned earlier, is to generate correlated returns and volatility, both lower than the benchmark index, with a part of the returns paid out as income distributions. The ETF is required to invest at least 80% in equities and ELNs. The ETF is, however, not bounded to invest only in the stocks within the benchmark index, and also not necessarily in high dividend stocks. In fact, the prospectus is honest to point out that the portfolio currently has a bias towards tech stocks. The lack of hard limits gives the ETF a lot of flexibility to tweak the portfolio according to changes in market conditions. There is a limit of max 20% invested in ELNs though. This follows with a long paragraph explaining what ELNs are, which I won't be going through. I will come back to this 80-20 split between direct equities and ELNs later when we look at performance. Separately, there is also a max 35% cap on sector exposures. This follows with a pretty long description on the investment process that looks to be primarily bottom-up stock selection driven. The analysis on the stocks are done through what the team calls fundamental data science enabled investment approach that looks to be using computer models to help sift through and process large amounts of relevant data to derive the forward-looking financial value of the stocks and then invest in those that are priced cheaply in relation to that financial value. The prospectus for the Europe listed version has slightly different clauses. In particular, there is a minimum 67% in US equities, instead of limit on generic equities. The Europe version can also sell call options on both stocks and indices. It is not clear if there are any allocation limits to options or ELNs for the Europe version. That's all there is in the prospectus. If we look at the ETF marketing brochure, there is quite a lot of emphasis on income generation through the usage of option premiums, but nothing really on capital growth. This other picture in the brochure is more important. While not drawn to scale, it suggests that the portfolio potentially may not generate much stock dividends, and instead will be relying on option premiums as the main component for the income distribution. Given there is a max 20% allocation to ELNs, we will see later if this is really enough to cover for the distribution payout. In this same picture, there is also a clear indication that there will be some market upside that is foregone due to the nature of the strategy. We will need to pay attention to this later when we look at the performance to see if this exchange is worthwhile. As mentioned earlier, The JPMorgan Nasdaq Equity Premium Income ETF has both US and Europe listed versions. The US version was incepted in 2022 and has over $30 billion of AUM. The Europe UCITS version was incepted only in 2024 and has over $2 billion of AUM. Given the investment guidelines are slightly different, these two versions also have slightly different portfolio constructs, which we will go through. Here, we have the sector breakdown of the US version, Europe version, and Invesco QQQ ETF representing the Nasdaq 100 index. The Nasdaq 100 index is a pretty concentrated index with about 61% in technology and 19% in consumer discretionary. QQQ uses a different sector classification, so it doesn't split out communication services from technology. We can see both versions of JEPQ are similarly heavy in these two sectors, with the rest of the sectors having very small allocations. The allocations in the US version looks different from the Europe version, but that's because the US version actually indicates a 15.9% in others, which is really the allocation to the ELNs in the portfolio. So if we exclude that and rebase the other numbers, we will get very similar allocations between the US and Europe versions. It is good to provide this ELN allocation information, so I'm not sure why the Europe version doesn't have it. The same goes with the holdings details, where the US version looks to have lower allocation numbers, but again will be similar to the Europe version if we rebase the numbers to exclude the ELNs in the portfolio. The holdings do not look too different from QQQ. So even though the ETF has pretty flexible investment strategy to invest beyond Nasdaq 100 index, we can see the holdings are still near identical. Both the US and Europe versions allow investors to download the full holdings data into an Excel file, where it is easy to see all the positions, including the options or ELNs. At the moment, it seems that the Europe version is also only selling call options on the index instead of single stocks. The US listed version provides historical trading premium or discount information for the past calendar year and quarters of the current year. Looking at 2024 data, the ETF looks to be trading consistently close to the NAV through the whole year, which is good. The Europe version doesn't have a full year track record yet, so there is no trading details available. On a separate note, it does have multiple listings across a few exchanges and in different currencies. So investors considering the Europe version of the ETF should make sure you don't buy the wrong listing. Both the US and Europe versions charge a total expense ratio of 0.35% per annum. This is considered decently cheap for an actively managed solution. Providing a high distribution payout is a key objective of the JPMorgan Nasdaq Equity Premium Income ETF, and it is being promoted prominently in the fund webpage that the ETF provides a really high payout yield of over 11% per annum that is way higher than typical yields from various asset classes. Of course, it doesn't say what is being sacrificed for this very high yield, which we will explore later. The dividend history is available in the ETF webpage. For the US version, it is currently having around 11.5% annualized yield, and the monthly dividend payout amounts look to be generally quite stable across months. Given this is a US listed ETF, US withholding tax applies. The Euro version, on the other hand, looks to have a more volatile dividend payout than the US version. That being said, while it doesn't have a full year track record yet, the estimated annualized yield looks to be around 11% as well. Considering the Europe version is already net of US withholding tax, this may be more useful for investors looking to optimize tax concerns. Here is a Morningstar chart showing the full track record of the US listed version of the ETF with the NAV movement compared to the total return. While there have been some capital growth over the years, we can see it is not significant. Therefore, the main objective of the fund is really to provide that high distribution yield, and investors should not expect much in terms of capital growth. The JPMorgan Nasdaq Equity Premium Income ETF, or JEPQ, webpage provides pretty comprehensive performance data. that compares to the benchmark that is Nasdaq 100 index. As mentioned earlier, JEPQ has a consistently small premium discount gap, which means the market price traded by investors gives nearly identical returns as the actual NAV of the ETF. Comparing against the benchmark, we can see that JEPQ has lagged behind by about 5% per annum, looking at year-to-date, 1 year, 3 year, and since inception periods. However, if we look at calendar year returns, we can see that JEPQ was actually quite close to the benchmark in 2024, but lagged behind by about 19% in 2023. Here is a full performance chart since inception of JEPQ, comparing against QQQ as a proxy for the benchmark. Here, we can see that JEPQ has obviously delivered lower returns than QQQ, though the volatility seems to be lower than QQQ as well. But is this a consistent observation? Let's slice this chart into calendar years. From calendar year perspective, each year seems to tell a different story. In 2022, since the inception of JEPQ, it actually managed to deliver better returns with lower volatility in a generally weak year for the markets. 2023 was a very strong rebound year, and JEPQ lagged behind QQQ by a rather big 19%. 2024 was a decently strong year, though this time JEPQ performed near identical to QQQ. Finally, on year-to-date, JEPQ appears to be tracking closely to QQQ until mid-May, where QQQ has a spike up, suggesting that there might have been one or more positions in QQQ that are absent in JEPQ that suddenly generated strong returns. If we exclude that few days of spike up returns, JEPQ would have performed near identical to QQQ again. So, while the track record is still not very long and therefore nothing is conclusive, JEPQ as of now looks to be able to generate near identical returns as QQQ in most market conditions, with the exception of very strong bull market situations where the ELNs will obviously reduce the upside participation in the market. What else does JEPQ do for investors? Well, JEPQ clearly provides a conversion of the bulk of the returns into distribution payouts, which is the big gap between the NAV line and the total return line. Having around 11% distribution payout every year sounds attractive. But an investor can also simply manually do partial redemptions to get the income you need, where then the main concern would be whether the investor has different tax treatments on dividend payouts versus realized capital gains. I can't give tax advice on this, so this really depends on individual investors' situations. But if there are no tax implications, JEPQ doesn't look that attractive anymore, and it would be simpler to just invest in QQQ to get the full market participation. The low capital growth compared to QQQ, despite having about 80% of the portfolio invested in direct stocks, also suggests a significant chunk of capital gains are converted to distribution payouts as well. Another ETF with a similar strategy mentioned by my viewer is the NEOS Nasdaq 100 High Income ETF with the Bloomberg ticker QQQI. It has a much shorter track record, having incepted only in January 2024. And also a smaller AUM of about $5 billion currently. The track record has been very similar to JEPQ, with the exception of the spike up in mid-May where it tracked the benchmark while JEPQ didn't. That being said, the track record for QQQI is too short to assess whether it will do better than JEPQ in different market conditions. Lastly, here is a comparison of the US version and Europe version of JEPQ. As seen, both versions are highly similar in both NAV and total return lines. For investors who have concerns on US withholding tax on dividends, it would therefore make more sense to go with the Europe version instead. With that, let's summarize our findings. The JPMorgan Nasdaq Equity Premium Income ETF is a product from JPMorgan AM, a global leading asset manager that is under the large JPMorgan Chase business. Active ETFs seems to be a product category that JPMorgan AM is aggressively growing, so there is definitely plenty of resources and effort put into the product. The ETF has a nice mix of 5 co-managers with slightly different skill sets in US equity investing. The ETF strategy is relatively straightforward, which is to provide a slightly lower return and lower volatility expectation versus Nasdaq 100 index through active management and ELNs, and convert the bulk of the returns into high distribution payouts. While the track record of the ETF is not too long, it has so far been able to generate similar returns as benchmark in normal market conditions, and do slightly better in bad market conditions. However, it seems to lag behind quite a bit in strong bull market conditions like 2023. While the main selling point of the ETF is the very high distribution payout of over 11% per annum, investors need to understand that by receiving the high payout, it simply means there is less capital remaining in the investment for future growth. Investors who have a bullish view on the market directions should choose to stay invested in the market. The high distribution payout can also be replicated manually by making partial redemptions on the investment as and when needed, which takes a bit of extra work but allows investors to better manage the investment. The main concern here is therefore whether there are any tax implications on distribution payout versus realizing capital gains, and this would be different for each investor. For investors who are concerned specifically with US withholding tax on distribution payouts, the ETF comes with a Europe-listed version that would have the payouts already net of such taxes. In conclusion, I feel that JEPQ is a solution designed to generate similar returns as Nasdaq 100, but with a slightly lower return, lower volatility result. The main purpose of the ETF is really to convert the bulk of the returns to distribution payout, which appears to be more catered for investors who have a concern on tax handling on distributions versus capital gains. Investors without such concerns should simply go with QQQ to participate in the market. This concludes my absolutely biased comments on the JPMorgan Nasdaq Equity Premium Income ETF. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.